Central bankers delivered a subtle but potentially historic message at Sintra, a move away from data dependence and forward guidance. To break down what this means for the market, I'm joined by Shriya Samarth, rate trader. Thank you for joining us, Shriya.
Thanks for having me.
So you argue that Sintra marked the beginning of a new era for central banking. What changed and why do you think the markets could be underestimating its significance?
Sintra was really monumental in that there was a central banking panel which included Andrew Bailey of the Bank of England, Christine Lagarde of the ECB, and also Kevin Warsh of the Fed. And they all agreed on a couple of very critical points in this strange hiking cycle to combat inflation. They agreed that relying on data no longer gave the full picture. So Sintra marked a move away from forward guidance and toward credibility of central bankers instead. In a world where data can't be relied on, credibility is critical so that central bankers can act really quickly to combat inflation. And that's very different than the world we saw the ECB operating in. They have been data dependent for ages, going back to the European sovereign debt crisis. And to suddenly ask for that faith in central bankers is a huge, huge shift.
And then if central banks are moving away from forward guidance and data dependence, what does that mean for bond yields, inflation expectations, and how investors should react to economic data such as the non-farm payroll, for example?
So NFP was a really good example of what happens in this post-Sintra world. NFP was a huge miss, 57K versus 113 estimates, and the whisper number was even higher. It was around 140K. For an NFP miss to lead to 2-year and 10-year yields making a round trip back to where they were pre-NFP, just around June 30th, that just proves that data has less value in this world. That's exactly what Warsh and the other central bankers warned us about. Data doesn't tell the full story anymore. That's what task forces and central bank investigations are now for. In that world, there's no need to overreact to data. There's no need to react to it at all. You can kind of shrug it off and say, look, if the data is really, truly terrible and persistently terrible, then my central bankers are going to react. So after NFP, we saw exactly that. We saw 2-year yields for US Treasuries sort of trend back to that 411 to 414 territory, and 10-year similarly around 446. You would have thought that a big miss like that would have changed rates permanently for a short period of time at least. But that's not what happened. That's our new world.
So on the back of this, are there any trades that would need to be reevaluated or repositioned for this new era?
Yeah, I call it the Sintra steepener. So in Kevin Warsh's world, we originally thought a flattener made sense fundamentally because his goal is to bring down long-term yields. So in the 10-year to 30-year space, he's going to try and keep a lid on those, which is naturally going to be a curve flattener. But in the meantime, we can see the front end is really driving this adjustment in a world where we just trust central bankers to act if and when they need to. The OIS curve is actually starting to take out some of those aggressive hikes that had been priced in when Warsh was first announced as Fed chair. And as it does that, the 2-year yield has been trending downward to accommodate it. The OIS curve used to think that we were going to get over 33, 35 basis points of cumulative hikes by year end, but now that's below 30 basis points. So we can already see that adjustment happening. The reality is Warsh said he was hawkish or seemed that way, but hawkish doesn't necessarily mean that he's going to hike rates. It turns out that hawkish just means that he's going to act if he needs to. And the market is now adjusting to that reality.
Well, thank you very much for breaking this down for us. For more videos like this, please do like and subscribe.